But to me, it seems pretty obvious that central banks are starting to favor gold and other commodities. Some of them are buying oil. Some others could be buying silver. We only know things that are happening disclosedly. Who knows what's happening undisclosedly? Who knows how much those central banks are really buying of gold? What they're showing us is a interesting amount, but they might be doing, if I was a central bank, I wouldn't disclose anything of how much I'm buying. It's sort of a prisoner's dilemma kind of theory happening today. If you look at the gold volatility versus the treasury volatility, for the first time in 45 years, treasuries are actually more volatile than gold.
In a mid-2023 survey by the World Gold Council, WGC, 70% of central bankers predicted an increase in global gold reserves over the following 12 months. Nearly three-quarters of respondents highlighted gold's long-term store of value as a primary factor driving their purchases. Tavi Costa, macro strategist at Crescat Capital, notes a noticeable shift among Eastern societies and central banks from financial assets to hard assets like gold. This trend indicates a move from relying solely on traditional financial instruments toward holding tangible assets with intrinsic value. From January to April 2024, the Reserve Bank of India added 24 tons of gold to its reserves, a strategic decision to hedge against volatility amidst geopolitical tensions. According to RBI data analysis, this addition significantly surpasses the 16 tons added throughout 2023. Costa observes that central banks increasingly favor gold and other commodities over traditional financial assets. This shift is occurring incrementally, with some central banks also purchasing oil and potentially silver. This gradual move underscores a broader trend of diversifying away from conventional financial instruments. As of the end of 2023, global central banks collectively owned approximately 17% of all the gold ever mined, with reserves totaling 36,699 metric tons. The majority of this accumulation has occurred over the past 14 years, following a trend of net gold purchases that began in 2010. Costa suggests that traditional investment portfolios, such as the 60-40 model, will likely follow as central banks shift towards gold. Large institutional shifts often trigger broader market movements, prompting other investors to reallocate assets towards gold and other hard assets. The WGC survey findings reinforce this trend, with a significant portion of central bankers expecting further increases in gold reserves. This sentiment reflects a growing recognition of gold's enduring value and its role as a safe haven asset in uncertain economic times. Join us as we delve into Tavi Costa's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Yeah, we've been seeing a lot of Eastern societies buying gold. Um, my take on that is just the transition is not like a lot of people think that they're really drastically increasing their international reserves as a whole, but rather transitioning from a financial asset into a hard asset. And I think this is a real trend that the market is still maybe underestimating the the beginning of this movement, which most times tends to proliferate in other parts of the market. What do I mean by that? Back in the 1970s, and we've also had accumulation of gold in that period. When we broke the gold standard, given the sort of volatility was caused in currency markets because of that, and the surge of real assets and hard assets during that period relative to fiat currencies globally caused central banks to actually have to buy gold. Although they were not pegging their currency to gold, they were forced to improve the quality of their reserves. And that's really what monetary systems are anchored on, are in the quality of international reserves the central banks hold. And so we've had that situation happen. And then back, if you think about what happened in the 80s, early 80s, the treasury market and other sovereign debt instruments were really cheap. They were essentially being sold by double-digit returns, or I should say interest rates, at a time when inflation was likely at its peak, and it ended up being at its peak. And so central banks enter a period that I called a financially globalized environment where they started to purchase those instruments in a big way. and sort of finance each other's fiscal stimulus. And so that is why we've seen developed economies running deficits for so long, particularly the US. And um, just given the fact that other central banks were buying each other's sovereign debt and financing themselves through that process, that we went from central banks owning 80-70% of their international reserves in gold to about less than 20% recently. And so that also caused what it was called the 60/40 portfolios to be created, where institutions and other investors began to use the same trend. In other words, selling gold and buying treasuries, because how cheap financial assets were at that period. And that trend was basically a 30-year movement or shift into valuing financial assets at much higher valuations versus the other way around with real assets. Now we're on the other side of this today, and a lot of people are not seeing the signs, but these things, they don't happen all at once. We're just seeing a few dominoes falling here and there. But to me, it seems pretty obvious that central banks are starting to favor gold and other commodities. Some of them are buying oil. Some others could be buying silver. We only know things that are happening disclosedly. Who knows what's happening undisclosedly? Who knows how much those central banks are really buying of gold? What they're showing us is a interesting amount, but they might be doing, if I was a central bank, I wouldn't disclose anything of how much I'm buying. It's sort of a prisoner's dilemma. I believe that ultimately the 60/40 portfolios are going to chase that allocation as well. Traditional pools of capital will chase the metal too, because it all starts from a large institution making a big shift. And when that starts, it changes the whole game.
Tavi Costa highlights an intriguing development in the relationship between rising interest rates and gold's performance. Traditionally, higher interest rates have led to skepticism about gold's prospects. However, recent trends have defied expectations, with gold prices rising alongside interest rates, a scenario previously deemed unlikely by many investors. Analysts suggest that gold could find its next level of support at $2,300. They also point out that signals from the Federal Reserve indicating readiness to cut interest rates would be a significant catalyst for further price gains. Costa observes that as correlations between traditional assets such as equities and fixed income shift, investors may increasingly turn to gold and other hard assets for stability and diversification. This sentiment echoes a broader theme in central banking, where diversification has become paramount. The U.S. has increasingly leveraged the dollar's status as the world's reserve currency as a foreign policy tool, prompting many countries to minimize their exposure to the dollar. This strategy has driven a significant trend of gold moving from the West to the East and into emerging markets. Let's get back to the interview.
The big shifts are going to happen when retirement funds and other things just start to really diversify their capital into gold and others. And most of those retirement accounts, they have sort of an automatic approach to allocation. And a lot of times they don't even know what they hold. It's a lot of mutual funds that essentially are forced into them, what they call aggressive, conservative, and they don't own any gold usually. So as we see investors begin to not only ask for better performance and other things, eventually those capital flows will be attracted by the metal, and or the metal will be attracted by those flows, the other way around, and that also will push prices most likely much higher too. And so that is sort of what we're seeing, and we have to think about this from a perspective again of what the priorities are. A central bank buy gold for different reasons than a traditional pool of capital. Traditional pool of capital is looking for correlations that tend to be, highly efficient at times, such as buying a large percentage of your portfolio in equities and then hedging that position with a large position in treasuries or fixed income. But then when you reach a period where an inflationary era is unleashed and you have cost of capital rising, it changes the correlation of markets. Who would have thought that gold would be rising with interest rates rising? That not too long ago, that was the main question I had to answer to my investors and folks in the media, because people just had a total disbelief that that was even a likelihood that could potentially unfold. And looking back in history in the 1970s, another inflationary era, that certainly was the case. And so, looking at today's environment, I believe that we're starting to see those correlations shift. And as they start to become more and more obvious for investors, and they don't change completely. I mean, they change and then they go back. So I'll give you an example: the value to growth, right? I mean, we had a major transition from growth to value in 2021 that actually came roaring back in 2022, 2020, I should say 2023. And now, where technology companies went all the way back to retest their prior highs and make new record levels depending on the share price, and so those things are normal. They're not going to happen all at once, but certainly there are some very key correlation shifts happening in markets across assets, and I think some of them are long-standing and not short-lived.
As global central banks, particularly in Eastern and emerging markets, continue to diversify their reserves, the movement of gold from west to east underscores a significant shift in the financial landscape. This shift is not just about hedging against volatility, but also about securing tangible assets with intrinsic value. How should individual investors adjust their portfolios in response to the increasing trend of central banks favoring gold and other hard assets? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.